Good afternoon, everyone, and welcome. I am Nick Ryland, co-founder and certified financial planner here at Vantage Point Financial, joined here by my co-founder, Tim Kuntz, who is also a certified financial planner. And we have a special guest, Jess Riley. We'll give him a more formal introduction here in a minute. But happy you're all here to join us. Excited to have you here for the next hour. We'll keep it within the hour, and let's kick it off here with an agenda. All right, so we're going to touch on our elevated retirement plan that most of you that are clients have heard many times, but we'll touch on the components that we're going to cover today in this webinar, which will cover legacy, long-term care planning costs, funding, and we'll even dive into some taxes. And also, please, if you have questions, please click on your Q&A button. If you don't see that on your bottom kind of toolbar here on Zoom, if you click more, it should pop up there and you can put your questions into that section. We'll definitely leave time at the end to answer questions. If we have time throughout, we'll try to jump on those. So feel free when those come to mind to just click that Q&A button, type in your question, and we'll be sure to address it during or at the end. Next slide there. All right. So our elevated retirement plan, we are blessed to work with so many great families across the country that need comprehensive financial planning. And I'm sure most of you, if not all of you, have seen our elevated retirement plan. It's our trademarked financial planning process. 6 key areas that we cover and intertwined together. They are all very well connected and they need to be in a very coordinated plan. As I mentioned today, we're going to focus on 3 of these areas. We're going to touch on legacy planning. We're going to touch on the healthcare and insurance piece, long-term care costs, funding, things like that, and then also the tax management piece and how all these things are interconnected. Kick it over to Tim.
So, those of you who may not be as familiar with our company, Vantage Point Financial, we have 3 office locations here in the Chicagoland where we're coming to you from today. We have an office in the Detroit metro area and St. Louis. The combined experience of all the experts on our team is well over 150 years. It's really a pleasure working with our team here and using it all to cultivate what has become our elevated retirement plan, like Nick just described. Across our offices, we have 33 team members, and in addition, we also have a kind of standalone tax practice as well, where we do fractional CFO work, bookkeeping, accounting, tax returns, etc., for families, businesses, and individuals. What's really important to us here at Vantage Point is your clarity and confidence. We believe you've earned the right to clarity and confidence in your retirement, and it's something that we strive to provide to all of our clients through this plan process that we've designed, the Elevated Retirement Plan. What we do would not be possible at all without a team. The work we do is extremely detailed, extremely complicated, and it really does take a village. We're so blessed to work with so many wonderful people here at our office. You can see here a few of the members of our team. Our advisor team is up on the screen right now here in our Chicago office. And of course, we also have a service and ops team as well that really grease the wheels around here. Like I said, what we do would not be possible without all of them. For those of you on here today that are our clients, I know you have a wonderful experience with all of our team. And for those of you who haven't met them yet, I hope you really get the chance because they're all really wonderful people. Another part of our team are some of our partners. We have a absolutely huge bench of people standing behind what we do at Vantage Point. And Jess Riley is part of a team that has helped us internally and helped a lot of our clients with some very strategic, high level, and extremely detailed planning. He is a wealth of knowledge on very complex estate, legacy, and long-term care planning. He's advised us on a lot of really complicated cases for some of our clients. And he's part of a bigger team that stands behind us that does unified planning across our elevated retirement plan to kind of bring all these things together. So I'm really excited you guys get to hear him talk today on some topics that are near and dear to our hearts, and of course, a really big part of the work that Jess does every day. So thank you, Jess, for giving us your time today. Thanks for giving it to our clients in our community. We so appreciate it. And I'm really excited to hear your presentation today.
Well, thank you. Appreciate it, Tim and Nick. I'd just like to say to everybody on the webinar today, thanks for allowing me to jump on for a few minutes and share some thoughts. and information I think can really be impactful for your retirement plans as well as your legacy planning. Been lucky enough to work with the Vantage Point crew for several years now, and what I can tell you is you guys are working with the best of the best. I've seen financial advisors all across this great country, and sometimes you get some good ones, sometimes not so much. But what I can tell you with this group, as well as the St. Louis and Detroit offices, is this is the cream of the crop. They really are invested in their clients, their plans, and will stop short of nothing to make sure that they're trying to give you that best retirement possible. So I just appreciate the opportunity to jump in with you guys. As Nick mentioned at the beginning, you have questions while we're going through, feel free to throw them in the Q&A section. We'll try to address some of those as we go, but we will definitely have time at the end to answer any questions that you may have. I'll admit that I kind of nerd out on some of this stuff, so I get rolling, and sometimes I may ask them to just jump in if there's a question I don't see. So we'll get after it today, and again, just appreciate you guys taking the time to join. So one of the things that we talk about a lot with the financial plan is legacy. Estate planning can fall under that heading as well. But really, at the end of the day, when we're planning for the next generation, we want to know what do you want to happen with any funds that may or may not be left. And one of the things we hear a lot is, "Hey, I've got money earmarked for my kids or my grandkids, or maybe for my college or some other things where they want to leave that money." And when we talk about where that money is currently held, many times it can lead to some pretty devastating tax implications for not only you, but also for your beneficiaries. And so one of the areas that I had asked Tim and Nick to address with you guys is what we call our legacy amplifier. And this is a strategy for folks who have legacy goals and just need some guidance on how to best reach those. So we're just going to jump right in, guys. And I find the best way to do this is to walk through a case study. This is a real life case. Obviously, we're not going to share any personal details, but I want you to kind of see how we analyze these things and how we built a plan that I think is going to meet this client or these clients' specific goals. So when we're looking at the case study here, this is a 70-year-old male, 67-year-old female. Basically, they've got IRA money that they've earmarked for legacy. Just some assumptions here. We want to be conservative on some of these things. I know 100% that the Vantage Point team can get you a better rate of return over time than 5%, but we don't know exactly when we may have market adjustments, things like that. So we want to be conservative on these assumptions. So you can kind of see the scenario that we're looking at. And what we also know is that most people, including myself, have been told since we were little, "Hey, if once you start working, use your 401k, put money in your IRAs because we get that great tax deferred growth and compound interest over all these years," which is a great thing. When we get to the distribution phase or when we get to the legacy phase, that may not always be the best thing, right? Because Uncle Sam is always going to want his cut, for lack of a better term. So when we look at folks that have IRA money that's earmarked for legacy, we want to analyze that and see if there might be a better, more tax efficient way to pass those monies on. So that's what we're going to cover today. So this is a screenshot. Forgive me, it's a little rough to see here, but you can see the top of the screen, we've got their current IRA account. And what we're doing is we're taking snapshots 10, 20 years into the future to see what would be left for your heirs when we take taxes into account. Now, again, this is never taxed money that we're looking at here. If we look 10 years out and we assume 5% growth on this account, the projected end-of-year value is going to be about $601,000. If your heirs inherit that lump sum IRA, they're going to end up paying around $200,000 of taxes. Now, we're using high-level information here, and you can see I have a 35% tax rate applied to that money. Guys, whether or not your kids are making enough money to be in that top bracket, if they get $600,000 all at once in the form of your IRA, it's going to bump them up into that bracket. So that's why we're using that amount. Now, I'm sure you've also talked to the Vantage Point team about required minimum distributions. When we hit that magic age, whether we need or want those funds from the IRA or not. Uncle Sam says, hey, we need to start generating our tax revenue. You have to start taking them. And most folks are not going to take those RMDs and put them under the pillow or bury them in the backyard. They're going to be wise with that money and reinvest it. So we're accounting for that here in the reinvested RMDs column. So if we snapshot 10 years out, that $500,000 IRA that you wanted to leave to your kids is going to end up being about $550,000 after taxes. But remember what we've done by kicking them into that top tax brackets. Now we're making more of their income taxed at a higher rate. That's not typically what we're looking for. Also, with that being said, you guys remember the ages of the clients here. 10 years out probably isn't a real good snapshot at life expectancy, right? 70, he's going to be 80, 67, she's only going to be 77. So I think more realistic is looking 20 years out where he's 90, she's in her late 80s. And we can do the same math here. The IRA account value after we've taken our required minimum distributions is going to be about $517,000. Your heirs, if they're your children, are going to end up paying about $181,000 of taxes on that qualified account. Then we have a whole bunch of reinvested RMDs that are also going to be taxed when your kids receive them. So the total value 20 years out is 910 grand. Now, when I look at that from a high level and say, hey, I've taken 500,000 and when it's my time to go, my kids are going to end up after taxes at about 900, a little over that. That's not a terrible thing. But what I'm always looking for is how can we help with the tax situation and how can we create leverage, right? Because that's what a lot of this planning is all about is how do we leverage the dollars that you've worked so hard to save? And really that's when the legacy amplifier strategy comes into play. So now I'm going to show you the other side of our report. And I do apologize, guys. I realize that this is a little bit small, but I want to hit on some specific numbers here. So we're working with the same qualified account, the IRA of 500 grand. What we're suggesting is taking a small distribution from that IRA each year to create leverage and to create tax benefits. So how you guys need to envision this is it's not creating money out of thin air. You're simply taking money from your left pocket, moving it to your right pocket. If we do that at a 5% rate per year, of 500,000, that means we're getting 25,000 out of that IRA account every year. And we know that's fully taxable. We certainly understand that. So we're suggesting that you hold out the amount for taxes. That leaves you with about $19,500 after all taxes are accounted for. If we take that amount of money and we put that in a tax leveraged vehicle, it will generate what we call a death benefit of $973,000 day one. Okay, that's completely tax-free to your heirs. So again, moving money from left pocket to right pocket, we're creating an additional 900 plus $1,000 of benefit for your kids. That's completely tax-free. Now let's look at the same time frames, guys, 10, 20 years down the line. If we're looking 10 years down the line, I'm not sure if you can see this, but by implementing this strategy, your kids, if that's who you're leaving your money to, are going to get 134% more than they would have just leaving the money as is. Looking at life expectancy, those numbers adjust a little bit, right? Because we have growth on the IRA funds and all these other things. We're still at about 40% advantage at life expectancy. So by moving money from one account to another account, in other words, from your left pocket to your right, we're creating 40% additional after-tax dollars for your heirs. Now, one of the questions that I get asked a lot on this is, okay, I have that 500,000. My goal is to pass that on to my beneficiaries. Life changes. What if I need that money? What if all of a sudden we have an emergency and I need to tap into that? Guys, the one thing I want you to notice when we're working with Tim and Nick and the other financial planners here, we're not draining that IRA account completely. We are always leaving money in that account so that in case of emergency, you always have access to cash or money from that account. Okay, so I just want to highlight that. The other thing that you guys may be thinking, and you could probably see it here, I tend not to lead with it, is what can we take $19,500 a year with and create $973,000 of tax-free money? This is what we call our survivorship life insurance policy. Life insurance is designed for efficient wealth transfer, among other things. The reason, guys, that I didn't lead this topic saying, hey, let's talk about a life insurance strategy is because I know many of you, like most folks I talked to about this the first time, if I say, let's talk life insurance, I've lost you before we even start. That is not a topic that a lot of folks want to talk about because it makes you think about kind of end of life, your own demise, things of that nature. So the reason that I present it the way I do is because I want you to see the benefit. I don't really care what the vehicle is that produces this benefit and leverage. I just want to make sure we're maximizing those things for you. So that's the type of policy we're using here is we're using this insurance wrapper around the plan to get that tax efficient legacy and also immediate leverage, right? So like I mentioned, turning that premium of $19,500 each year into a $973,000 benefit for your heirs that's completely tax free is a great thing. So that is a very underutilized strategy. I hope this visual is a good way to show you guys how money in qualified accounts, while still very valuable, you've done a great job saving those funds, is not always the most efficient or effective when it comes to actual legacy or wealth transfer to the next generation. So I see we have a couple questions in there. Tim, Nick, is there anything I need to jump on now, or do we want to wait to the end on those?
It looks like someone was just citing that the sound was reverberating, and they asked if anyone else is experiencing this. So just do a quick little pause here. If anyone else is experiencing issues with the audio, would you be willing to just add in a question to the Q&A to confirm if you are or are not? If I don't see anything roll in, we'll keep going.
Okay. Yeah, I'm not sure if it's just a little echo in the room I'm in. Hopefully that's not anything that's too distracting for everybody.
The sound has been okay on my end.
Okay. Well, let's go ahead and move ahead, guys. We've got a lot of stuff to cover, and we'll keep cruising along here. And then if there are any other issues or questions, just please throw them in, and Tim or Nick will bring those to our attention.
It looks like the person who is having some audio issues says that everything seems okay now. So
Okay.
thanks for
Awesome.
confirming that. We appreciate it.
Thank you, guys. Okay, so folks, that's the legacy amplifier strategy. Again, this is a case study. All of these are specific to your situation. So if this is something that you would like to explore or chat further with, the Vantage Point team will definitely connect and kind of work through your specific scenario to see if there's a strategy that makes sense for your legacy goals. Now, I'm going to switch topics a little bit, guys, to long-term care planning. This is what the bulk of the presentation is going to cover today. And I'll tell you the reason why. 5, 6, 7 years ago, when I would bring up long-term care planning, I would get some interest, but a lot of folks sort of wanting to discuss other topics. What I've noticed since that time is that we have a lot of folks that are in that 60, 65, 70-year-old range who are saying, hey, I need to learn more about this topic. And the reason why, a lot of you folks have gone through long-term care situations with family members, whether that be parents, siblings, spouses in some scenarios. And so when you see how lack of planning for this can really impact an overall retirement plan, it brings that front of mind. And so we get a lot of questions here on the Vantage Point team about this. What are the ways that we can plan for this? And that's what we want to talk about today. Now, I told Tim earlier, normally when I do these in person, I will ask the room and poll them, who has dealt with a long-term care experience with a loved one or a personal issue, and I'll have them share. And most of the time, those experiences have not been very positive. Since we're on a webinar, I'm not going to call anybody out and make you, jump on the microphone, but I will share a personal story to kind of help bring this into focus. So I grew up in a very small town in Southwest Kansas. If you can believe it, the whole town had 2,000 people. So farming community. Both my grandparents lived there. I grew up seeing them, every week. Great experience for me. My grandma on my dad's side lived to be 100 years old, and she is one of the cool, or was rather, one of the coolest ladies you'll ever meet. Very nice, humble, lived through the Dust Bowl, seen pretty much everything. She built Dream House with my granddad when they were in their 40s. My granddad passed away of heart disease when he was in his mid 60s, which meant Graham, as I call her affectionately, lived by herself in that home from her mid 60s until about age 95. Um, around that age, she took a fall that kind of led us to make the decision, hey, it's time to get some care for her. There had been no planning in place. It's just, hey, it's time. In a town of 2,000 people, your options are a nursing home in that scenario, which Graham was certainly not interested in. But the decision was made for her health and care. It needed to happen. The nursing home happened to be right across the street from her house. So without proper planning, ultimately that dream home of hers that she spent, 40 plus years in had to be sold. So when Graham had to go to the nursing home, not only could she see her house out the window that she longed to be in, she also saw the day they had to put the for sale sign in the yard. Because there was no planning in place, you have to have assets to pay for this care because it's expensive, which we'll talk about shortly. So that was a very heartbreaking moment. And that's really when my family sat down and said, hey, guys, we do not want to see another family member go through this. With some proper planning, there are probably some different care options she could have received. May not have had to put that house up for sale quite so soon and some of those things. So I like to share that just to bring a real life story to this. I'm sure several of you have situations of your own that you can talk about. And we'll get into the ways that you can plan for this shortly. But again, just want to lay the foundation there. And when we're talking about cost, some folks may be familiar with this, some may not. Well, let's look at what long-term care costs are in your guys' area as of last year. And we're going to talk through each of these briefly so you know there are different types of care you can receive. And if you're like me and like most people, you want to stay in your home as long as possible. And that's what the top option here, the home health care is. That's when someone comes to your house, helps you with some of your activities of daily living. So things like, cleaning the house, using the restroom, things of this nature, making meals. That right now in the Chicago area is about $7,000 per month. And you can see on the other side of the screen here that those costs are increasing on average about 3% a year. Some areas are going to increase faster, some a little bit slower, but that's the average. Now, another option that people may not be familiar with is adult daycare. Most of us are not wanting to use this option because it is just like it sounds. This is when you have a caregiver that takes care of you in the evenings and nights. And literally, while they go to work the next day, they're taking you, like a toddler, to a daycare facility where they drop you off. You receive care during the day, they pick you up, and you go home. Assisted living, this is probably most people's second option after home health care. There's some really awesome assisted living facilities out there in communities. I mean, in fact, when I see some of them and people are rolling around on the golf carts, playing shuffleboard, having a good time, I'm like, hey, that doesn't look too bad to me. So when you look at those scenarios, assisted living, you have some independence that you get to maintain, but you have help with things like your laundry, the day-to-day stuff. And if you want a private room, you're looking at about $7,350 per month right now. What most people then focus on is this bottom option, guys, which is the nursing home care. Now, this is typically the last place people want to receive care. This is the first place you will receive care if you don't have proper planning in place. So that's why it's really important to think through this stuff and make sure you have protection in place for yourself and for your family members. Now, you can see two prices here, guys, a semi-private room and a private room. I don't know about you guys, but if I'm going to be confined to a facility, probably to kind of finish out my days, I don't want to share that room with a stranger. Even if you do share that room with a stranger, it's costing you north of $10,000 a month right now. So you can look at those costs as they increase by 3% every year, how ridiculous that can get. Most of us are going to choose that private room. That's almost $13,000 a month. Now, I'm not going to go through and do a math exercise, guys, but if you look at how much that costs per month, think of how not having a plan in place for that could really wreck your retirement plan. Typically, we're looking at a husband and wife. And if we know on average, a married couple will spend somewhere between $350 and $450,000 in unexpected healthcare expense in retirement, just think what that would do if the husband needed care sooner and we have to tap in to those reserves to pay for it. What does that leave for the spouse when he's gone? Right? So planning for this sort of thing is a way that you can make sure that no matter which spouse needs care first or second, that everybody is taken care of and nobody's left in a scenario where their only option is Medicaid, because that's not something that you want, I promise. So let's look at some more stats. And I'm sure that's, everybody gets excited about statistics, but I think this is something we need to point on. Us guys, we die younger, we do stupid things, our life expectancy is shorter. So naturally, when we do need care, we're usually needing that care for a little over 2 years. Now, what really happens, guys, I think we can all admit this, is we're probably needing care a little bit sooner, but our wives typically will take care of us. They're the superior gender in many ways. And when husbands start going down, the wives step up, take care of them until they can't anymore in most scenarios. And then that's when we start receiving care. So think about that scenario where a wife could be a caregiver, for instance, or a husband, vice versa, it doesn't matter. But if they spend a couple of years caring for their spouse and then their spouse passes away, think of the extra stress that that's put on them as a caregiver, not just the financial side, but mentally, right? And then when they need care, how are they going to get it if we don't have any funding in place? So you can see that females, they live longer than us, which means they're probably going to need care for a longer period of time. We're right at that 4-year mark. And there are those outliers, guys, where we have dementia, Alzheimer's diagnosis, where you need that round the clock care. That can be 8 years. So think about that number, that $13,000 a month for anywhere between 3 and 8 years. That's very, very, very significant. Again, without planning in place, if you burn through all of your assets, Medicaid is an option. But one thing I want to make sure everyone on this call is aware of is that Medicaid is not ideal. Medicaid nursing homes typically have lower levels of care. And also, you don't get to choose where you go. So if you are using Medicaid to pay for your long-term care, you go where there's an open bed. That may be right next door. That could be a town 30 miles away. You have no say in that, right? So the stuff we're talking about are ways to maintain control so that your last years are spent being cared for the way that you prefer and deserve to be cared for. So then the questions become, how are we going to pay for all this stuff? Who's going to pay for it? Are you going to become a financial burden on a spouse or children? And this is something I want you guys to think about, because a lot of us will have kids that say, look, Mom, you're never going to assisted living. You're never going to a nursing home. I'm going to take care of you. Being a caretaker literally shaves years off of people's lives. We talked about that already. But think about the other part of that, of what being a caretaker means. Do you want your children to help you with some of the activities of daily living that you'll need assistance with, like using the restroom or taking showers, things like that? Typically, that's not something a parent's going to want their child to help them with, even if the child says, hey, I'm game, I'll do it, right? So think through these things. What does that really look like? And if not planned for, this is what I mentioned earlier. Who gets your hard-earned money? A government or a long-term care facility, right? If we're not planning for that and we're spending down assets and using things like Medicaid, really, what does that accomplish for you? And the big thing that I hope to accomplish on this conversation today, guys, is to look at long-term care planning not as an expense, but an investment in your financial plan. Too often people will look at a long-term care policy, for instance, to say, man, this is an expense that I have to pay every single month. I hate that. If you flip the script on that and say, look, this is an investment in my retirement plan, which means my spouse or my kids are going to get the legacy they deserve without blowing through all that money to pay for care, that's ultimately what we want. Again, so when we're looking at this stuff, you really need to have that paradigm shift and view this as an investment in your full retirement plan, because that's what it is. So I could really nerd out on this stuff, which will do none of you any good because you won't care about all of these details. But I do think it is important to kind of show you the different types of plans out there that can help pay for your care should you need it. Now, a lot of you are probably familiar with this top option, which is called traditional long-term care insurance. And if I'm presenting in a room full of people, I'll ask for a raise of hands who is familiar with this, who's had experience with it, and then again, ask them to share. Here's the thing with traditional long-term care. We don't do a lot of that. We don't believe in a lot of that here at Vantage Point because of one main reason. It typically comes with an increasing cost and a decreasing benefit over time. Vantage Point is not in the business of helping you guys with a solution that gets more expensive and provides less benefits the older you get. Okay. Traditional long-term care, the idea was great around it, but it has been mispriced. And what that means, without getting too into the weeds, is every few years, people who own traditional long-term care policies get a letter that says, "Hey, Jess, thanks for being a client for the last 5 years. To reward you for that, we're going to increase your premium by 7%. Or if you don't want to pay more, we're going to decrease the benefits that you've been paying for the last several years." I don't know about you guys, but that is not the kind of letter I want to get. I don't feel a lot of value coming from a product like that. So we won't spend any time on that. Where we tend to focus on here are these middle two, or this middle option and the bottom option, which is called asset-based long-term care, or a life insurance policy that's got a long-term care rider built in. The reason that we want to focus on these guys, number one, no fear of rate increases. When we look at these types of solutions, you do not get the letters in the mail that I just mentioned. Your premiums are guaranteed. They stay level. There will be no changes unless you decide you want to make a change in your benefit. The second reason, and probably the biggest reason, is because it's not a use it or lose it solution. Okay. When we look at things like car insurance or home insurance, things like that, we pay those premiums every month, every year. We hope we never have to use them. With solutions like this that are designed to protect you from long-term care event, we don't want to just throw money down the well. We hope that you never have to use it for long-term care, right? But if you, in that scenario, we want to make sure you're not just wasting that money. So the reason I mention that is on these policy types, the asset-based long-term care and life with LTC rider, if you don't use it for your long-term care needs, your beneficiaries are going to get a leveraged, tax-free death benefit. So that's how it's kind of taking care when Nick and Tim at the beginning of this said, "Hey, we're going to focus on tax, healthcare, which includes long-term care and legacy." If you look at some of this stuff, it's really attacking all three of those areas because all of the benefits that pay out of these solutions to fund your long-term care costs are paid to you income tax-free. If you don't use it, there's a tax-free legacy that goes to your heirs. And obviously, we're building a bucket of funds that's going to pay for the LTC costs. So really, when you look at some of these options, it's one of the few vehicles that can cover multiple worlds that we talked about at the beginning. So again, what's best for you, what may be the best benefit for your family, that's a one-on-one conversation. We would never best to say this fits everybody or that fits everybody. So which is best for you really depends on your scenario and what your goals are. But when you're talking to the Vantage Point team, they're going to focus primarily on asset-based long-term care or life with LTC benefits because they don't want you throwing money down a well that you can never get back or never benefit from. So how do we fund these solutions, right? Because again, nothing's free, and we're going to kind of talk about what the costs look like shortly. But when we're looking at our buckets, the now, soon, and later buckets, which I'm sure you've heard from Tim, Nick, the rest of the advisory team, if we're going to fund something in to cover these costs, how are we going to do it? Where's the money coming from? The now bucket is your income, right? We're not doing that. We don't want to get into that stuff. We don't want to disrupt any income flows. We don't want to get into any savings, right? These things are there to protect you. We don't dip into those to pay for things like long-term care insurance or asset-based long-term care insurance. So it's usually that later money, which is kind of in that basket that's really geared for growth, right? We're not using that for income. It's not our emergency or a safety fund. This is the amount that the Vantage Point crew is investing for you and really growing for you over time. This is typically where we're going to say, okay, let's see if there's some opportunity to fund some of this protection out of this later bucket. So the types of monies that we typically have in that later bucket is qualified accounts. So that we're going to call it IRAs, but that can also be former 401k, all of those things that are qualified accounts. And the other option is what we would call non-IRA money, or sometimes referred to as non-qualified money. And what we want to look at is how do we leverage each of these to create the benefit that you're looking for? And there's a couple different scenarios that we'll go over now. The IRA money is going to be somewhat similar to what we started with, but a little more of a long-term care focus. So let's just jump into that and kind of see what that looks like. So if you're looking to use your IRA money to protect for long-term care, we want to do an exercise to see how that works. So we've got a 65-year-old male, and in this particular scenario, he's got $250,000 in his IRA that he's not using for income. Really, that's just in that later bucket where we're trying to grow that. His ultimate goal is either to have some LTC protection or, pass on some money to his children. So one thing that you've probably talked about with the crew here is Roth conversions. Roth conversions really in that tax piece of the pie can be a huge, huge, huge benefit for you. It's like, let's bite the bullet on some taxes now to minimize our taxes later. It makes a heck of a lot of sense. So it certainly helps with tax efficiency. But remember, this particular client is concerned with the LTC benefit and also said, hey, if I don't need it for that, I would like to leave some money behind in an efficient manner. So when I look at that, I say Roth conversions can help with part of that, but I don't know that that's the best way. Here's what it would look like. When we do Roth conversions, we're not going to typically recommend that you do that all at once. Remember at the beginning when I was talking about how taking distributions from these accounts in a big lump sum can kick you up into really high tax brackets. So the planning that Vantage Point does is to look at your IRA account, optimize how we convert to make sure we're potentially filling up a tax bracket, but not jumping into a higher one. So in this scenario, we're converting that $250,000 over 5 years. So equal distributions once a year for 5 years. Now we know there's tax due on all that money. We're not blind to that fact. We don't want to gloss over that. So we want to hold money back for taxes. And if we do that and just assume no growth because we're doing simple math here without a calculator, my brain just, we don't want to get too complex. But that leaves in your Roth account at the end of the day $200,000 of tax-free money. So you're $250,000, you've taken the tax hit, now you're left with $200,000. The beauty of that is every penny of the growth from here on out is going to be tax deferred, actually tax free. And you pull the money out for yourself, it's going to be tax free as well. You can use these tax free funds to pay for your long term care costs. That's a great thing, right? It's not any reportable income just to pay for care. And if you pass away, obviously it's tax free to your heirs. There's some rules around that if you're a non spouse beneficiary. But for our purposes today, that's where you are after that conversion period. Now, what I would suggest is what we would call a leveraged conversion. Okay. So we're dealing with the same client, same amount of money, and we are doing the same distribution strategy. So we're still pulling that 50,000 out once per year over 5 years to get it into a tax-free bucket, same tax amount held back. The difference here, guys, is the second you do that first conversion into the leverage conversion strategy, instead of $200,000 available for a long-term care legacy, you immediately have $400,000. I'm going to say that again. You immediately have $400,000 tax-free for long-term care, or if you don't need it, for a legacy for your heirs. We're dealing with the same amount of money, the same account that we're pulling it from, but we're creating that immediate benefit. And by the way, like I mentioned earlier, there's not a scenario where we want you to lose full access to these funds in case you need it for something else later. this solution also has a cash value account that you can access tax-free. Okay. So when we talk about this, and I'm sure some of you are familiar with this, the solution that we're looking at in this particular scenario is called an IUL. So I period, U period, L period. Now the I stands for indexing. Okay. Most of you folks are familiar with fixed indexed annuities, may even own some. So the indexing component on this particular strategy works the same way. And for those of you that are not familiar with that, what that means is we get to participate in the upside growth of the market to an extent. But if the market goes down, the worst case is a zero. Okay. So that's the indexing part. It works just like an annuity. It gives us a lot of growth potential, protects us from downside. This is all tied to the cash value component that you see here. The U is for universal. Okay. We've talking about how we can use this solution in multiple ways. We're creating tax-free benefits for long-term care day one. We're creating tax-free benefits in the event that you pass away before you use it for long-term care. And we're also creating a tax-efficient bucket of money that you can access tax-free while you're alive, should you want to or need to. So the universals, like this thing covers you in a lot of different ways. And the L, I'll wait to see if anybody has any ideas. The L stands for life insurance. Same thing, guys. The reason that we don't necessarily lead with life insurance because I want you to see the benefit of these types of policies, how they can work for you in multiple ways, kind of like that Swiss Army knife. There's not many solutions out there that can provide this and still protect you from downside risk. Okay, so that's kind of the big reveals. We're also talking about another life policy here that's got long-term care benefits on it. If you'll remember what I said earlier, I do not care what the vehicle is called. I care how it benefits your plan. Okay, so that's where a leveraged conversion would come into play. If we want to help with tax efficiency, healthcare planning, and legacy, this is a great strategy to do it. Now, I will tell you the benefits and numbers vary a little bit by individual, by age, by health, things of that nature. But ultimately, this is a good snapshot of what you can get. And this, folks, is just kind of a ledger. Again, I apologize for the small print here, but this is the leverage conversion in action. So it's for that same 65-year-old client that had $250,000 they wanted to leverage. You'll notice this left column here is the premium. We're holding back taxes. So 20% has been held back for taxes. We're using $40,000 a year. And that creates that $400,000 benefit you see on the right-hand column. And what I'm really looking at is, okay, at what age do we think this client will, potentially need care? And what does it look like at that point? So at that point, your cash value column, which I have highlighted here, is now grown to $321,000. That's tax-free money you can access if you need while alive. Your long-term care / death benefit is at $400,000. So you've still got that leverage, but now you've got the added advantage of cash value. And by the way, you're not paying premiums into this any longer. After year 5, you're done with that. Right? So we want to structure these where there's a light at the end of the tunnel, but the benefits continue to grow for you over time. The last little snapshot, and I hope you guys can see, you may not be able to, but if I look at age 85, that cash value component is $460,000, and our long-term care and tax-free death benefit has grown to $482,000. So as these things build over time, your benefits will continue to increase with it. That's why we call this a leveraged conversion, as opposed to just a typical Roth conversion. Now, not everybody has qualified accounts that they'd want to leverage to help pay for this type of care. So that's when we'll talk about the non-IRA money options, what's out there. And guys, what I'm giving you today is just a very small snapshot. There are literally hundreds of solutions out here. Which one is the best for each of you individually or as couples really will depend on your goals, your scenario. And that's really what, Nick, Tim, and the sales team there will be able to help you kind of work through, not sales team and financial planning team. They'll help you work through those things. But I want to just show you an example of another solution that could work for you if you're dealing with non-IRA monies and you want to leverage those to fund this protection. Same client, same amount of money. This product is kind of unique. All right. This one is designed for a single premium only. So if you have maybe a lot of money sitting in CDs, maybe too much money sitting in savings where it's really not, providing any interest for you, not providing any leverage for you, this can be a great solution to use for a few reasons. Number one, it has a guaranteed return of premium feature. So for you non-insurance nerds out there, which is probably most of you, that just simply means, hey, if you put in $200,000 into this particular solution and you decide 30 days from now, a year from now, 5 years from now, that you really want to get that money back, you're guaranteed to get at minimum that full $200,000. Okay, so it's something that we really feel good about with that safe money solution because we can create leverage, but we're not taking away liquidity. But in this scenario, we want to look at what benefits it's creating. At age 80, which is 15 years down the line, you can see the highlighted benefit is 441,172. If you were to pass away, that's the amount that would pay to your heirs tax-free. If you needed it for long-term care, you could start accelerating that amount each month over time. Okay, and you'll see that these values continue to grow as well. Over time, the benefit increases, increases, increases. But this one's a little bit different. So remember when we talked at the beginning about the different ways to receive care? Nursing home was at the very bottom, but home health care, assisted living, things like that are up a little bit higher. Those have a lower cost per month, right? If you're receiving care in home health care, assisted living, basically anything but a nursing home, they take this benefit at the time you go on claim and divide it by 60 months. So that's 5 years. You get an equal payment each year, tax-free of $7,352. Okay. If you go to a nursing home, here's what this particular carrier knows. If you go to a nursing home, the cost is higher. We just talked about that earlier. We also know for a lot of folks, by the time you get to a nursing home to receive your care, the life expectancy is probably shortened a decent amount. So what they want to do is get more of that money to you faster, if that's how you're receiving your care. So instead of spreading that benefit out over 60 months, they said, hey guys, I'm going to give this to you over 36 months. So 3 years instead of 5 years. And you can see what that means. Instead of getting 7,352 a month, you would get 12,254 because that's going to be more in line with what the costs are. So, what I really like about this particular solution is that it identifies the differences in the type of care. It says, hey, if you're in a nursing home and you need more money and you need it quick, we're going to account for that. Again, same type of solution here, guys, in that the cash value component on this particular product is tied to the market to an extent, no downside risk, fully liquid. So again, this is going to be more of a solution if you just want to set it and forget it, like the infomercials say, give it a lump sum premium and be done with it. This is a great idea that you can use there. Now, here's one that I get a lot, and I say this, I probably argued this a little bit, maybe even with Nick and Tim. But we run into folks who have done really, really well saving. They've got a lot of money, and the idea for long-term care is they're going to self-insure. Can you do that when you've saved a good amount of money? Absolutely. Should you do that? Let's put that to the test. Because here's one thing that I know about people who have done really well with their savings and just people in general, including myself. I do not want to pay any more tax than I absolutely have to. I think that resonates with pretty much everyone. Like, I'm fine paying my fair share, but I don't want to pay more than I have to. And if there's a way I can do some planning to avoid that, then I'm going to take advantage of it. So let's see what that looks like very quickly. So let's talk about, what does $1 of long-term care really cost? Guys, we talked at the beginning of this about how most of us have a bulk of our money saved in IRAs, qualified type of accounts, right? So if we're going to pull money from that account to pay for long-term care and we need to cover $1, what does it cost? it's going to cost somewhere between $1.30 and $1.40. Now, some of you are probably looking at this going, man, your math is terrible. What in the heck are you talking about? Remember the tax piece. You have to pull out $1.30 to $1.40 from that qualified account, depending on your tax bracket, to net $1. So I don't really like that, right? That doesn't feel very efficient. That doesn't feel like leverage. I don't really like that because now I'm forced to pay this tax to cover my care. If you're looking at a non-qualified account, so maybe it's a non-IRA, it's just an investment account that you've been growing over time, and that's really the bucket that you want to use to pay for care. Guess what, guys? It's going to cost you between $1.15 and $1.20 for every dollar of care you need because it's either going to be subject to short-term or long-term capital gains tax. Can't get around it. It just is what it is. It's getting better, but I still don't like that, right? Now, any of you, bury your money in a glass jar in the backyard and just leave it there. You got a bunch of cash sitting under your mattress, right? And that's what we're going to use to pay for care. It's dollar for dollar. So when we're looking at the tax efficiency, I'm like, well, I like that better. But boy, it's not a good idea to bury $200,000 out in the backyard and leave it. So I don't think that's a realistic option. When you're looking at asset-based long-term care, which is a lot of the solutions we've been talking about today, you're going to pay 30 to 40 cents on the dollar. Okay. So when I don't want to call it objection, when I get that feedback of, hey, I've got enough money, I'm just going to self-insure, I'll say, yes, you absolutely can, but should you? And when we go through this analysis and we see that the leverage exists on the asset-based LTC and the tax benefits are better, it makes all the sense in the world. So again, even if you've done a great job saving, which I'm sure most of you have, don't write this off. This is something you might want to explore with your team there at Vantage Point, because again, I'd sure rather pay 30 cents on the dollar than pay $1.30 for that same amount of care. This is just a graph, guys. We're about done. I appreciate you guys sticking with me. This is sort of what we talked about earlier. This is the matrix. So if you have a scenario where it's like legacy is your primary goal, and the long-term care protection, yeah, it's on there, but that's not the primary goal. You're probably going to look more at an indexed UL or that single premium product I showed you earlier, because that's really going to get you a nice, strong death benefit with chronic illness benefits as kind of a complement. If you talk to Tim, for instance, and say, look, that Jess, he sure was a compelling speaker. I'm really focused on long-term care. That's my primary goal. Legacy's taken care of. Then you'll want to look more towards the asset-based long-term care, because what we can do there is create buckets of money that are very, very leveraged. You can add things like inflation protection to help keep up with those rising costs. There will still be a tax-free death benefit if you don't use it, but it just won't be as big as these other two. Your LTC benefits, though, will be larger. Okay, so this is just a matrix to kind of show you guys what's out there. Like I mentioned earlier, there are hundreds of product solutions. We don't pitch product here. We find what's the best fit for you all in your particular scenario, and that's what we'll bring to the table. So real quick, guys, to review, and then I'll turn it back over to Tim. We covered how the concepts we talked about today can cover 3 of those 6 worlds that we saw at the beginning. We talked about how do we fund this stuff? Is it from the now bucket, the soon bucket, or the later bucket? It's the later bucket every time. We talked about why we prefer asset-based long-term care versus traditional long-term care. Remember, we're not in the business of putting you in something that has an increasing cost and a decreasing benefit. We want to avoid that at all times. How do we fund it? That's the big question that comes up all the time. Again, most of the time, it simply is repositioning money from one pocket to the other. So I don't want you to think of this as a big expense. Again, think of it as an investment. And then lastly, guys, leverage. Everybody loves leverage. Nobody likes taxes. If we can pay pennies on the dollar to pay for that care, then we should do that every time, or at least explore it. So, guys, I appreciate the time. I'll leave you with that. Tim, turn it over to you. Of course, if there's any questions or anything, we're more than happy to cover those.
I have not seen any additional Q&A come in. I just want to take a quick pause and thank everybody. This topic in particular is extremely complex. There's a lot of depth to it. It's very sophisticated planning, and it's truly one of those areas of planning where there's not a one size fits all. One of our most important jobs as planners is listening to you and understanding what's important to you, and then working with teams like Jess and our financial planning team here at Vantage Point to help kind of paint the picture the way you want it to be painted. So, because of that, we understand that there's no way you could possibly glean all the information you need from your time with us today. We'll be sending an email to all of those of you in attendance and offering you to sign up for a 30-minute strategy session with us, just to dole out any questions that we might not have gotten to. Or if you're one of our clients and you're like, hey, I know we've talked about this before, maybe now's the time to try and fit this into our plan. You can more than happy to host you guys for a strategy session, just catch up on these topics specifically. So we know it's complicated. Jess, you did an awesome job just kind of distilling it down to the broad strokes here, and we really appreciate your time. So I'll hang out for a couple minutes. If anybody else has questions, you want to talk through them, but keep an eye out for a follow-up email in your inbox to sign up for that strategy session. For those of you on here today that are clients, don't hesitate to reach out to your advisor team if there's something more pressing that you gleaned from today that you want to talk through. But if nothing else, we thank you guys so much for joining us today. Appreciate your attendance and engagement. Virtual round of applause for Jess for taking time out for us today and breaking down such a complex topic for her. Really appreciate you.
Thank you guys very much for having me. And like Tim said, any questions, bring it to the team. We'll make sure and get you answers. And I highly encourage you all to sign up for those strategy sessions. There's a lot of things you can uncover there and a lot of benefits that you can leverage. So thank you guys again for having me.
Thank you.